Have you noticed that corporate earnings abroad have been falling, but global valuations remain high? It seems like a complete contradiction. Almost like a market glitch, but it's not. There's logic behind it, and it completely changes how international investors should interpret the current movement. If you're new here and you still don't know me, I'm Chad. I'm the presenter here at Zero Markets, and in this video, I'm going to break down the details behind high global valuations and falling earnings, clearly and objectively, so you can look at this topic with more critical thinking. In the world's major markets, especially the United States and Europe, we're seeing a very strange phenomenon. Corporate results are getting weaker, but prices keep rising. And it's like watching a suspense scene with a comedy soundtrack. Something just doesn't match. The big question, is this market strength or collective blindness? Guys, the answer isn't obvious. And that's exactly why it's worth unpacking what's happening. When we talk about high global valuation, we're basically talking about the relationship between price and profit. This multiple rises when prices go up or when profits go down. And recently, we've seen exactly those two things happening simultaneously in some markets. Imagine a company making less profit, but still attracting investors and seeing its stock price rise. Now, automatically, it becomes more expensive in valuation metrics, even if the business isn't delivering strong operational performance. But why does that happen? A big part of it comes from macro narratives. The global market has bought into powerful stories over the past few years. Expectations of future rate cuts, technological advances boosting productivity, and the belief that certain companies have business models resilient enough to navigate weak cycles. Narratives, when they're strong enough, attract capital, and when large amounts of money flow in, prices respond, even if earnings don't. Another factor is international liquidity. When large global funds fear regional risks, they seek markets perceived as more stable. And this creates heavy inflows into the stocks of major global companies, which end up rising even during periods of weak earnings. It's the classic money-seeking safety dynamic. And here's a detail few people talk about. A high valuation is not automatically a sign of a bubble. It can be high because the market sees future growth, because there are few attractive alternatives, or yes, because there's excessive optimism. The investor needs to understand which of these scenarios is happening, and that makes all the difference. Now, falling profits also require nuance. Lower earnings don't always mean a company is deteriorating. Sometimes it's the result of heavy investment, expansion, the economic cycle, currency impact, or even adjustments after years of strong performance. In other words, lower profits can be noise, a temporary phase, or a real problem. The point is, an international investor cannot look at these indicators in isolation. You've got to understand global flows, forward earnings expectations, and sector context. Markets price the future, not last quarter. And when you put all these pieces together, you realize that high global valuations can make sense in some cases, but can also be a warning sign in others. Reading the nuances is what separates conscious decisions from emotional ones. Interpreting valuation is not about predicting where the markets are going to go. It's about understanding why prices are where they are and what that means going forward. If you look at price, profit, flows, and narrative at the same time, you start seeing the global landscape in a much more mature way. And that puts you ahead of most investors who only follow headlines. If this content helped bring clarity to anything, go ahead and subscribe to the Zero Markets channel.